morning everyone. Goeiemôre van Kaapstad, WNA Waterfront. Thank you for everyone who has decided to join us for today's information session on the developments in relation to the loop structuring restrictions that has recently been lifted. Just to mention, this session will be recorded. So if anyone is interested in listening to this session afterwards, please get in touch with Ben Reboyson or myself, and we will be emailing a link of this recording to you during the course of the week. For those of you who don't know me, I'm Corinne van der Merwe. I have been a director at Sovereign Trust for just over 10 years now. And during these years, I've been involved in setting up and establishing many offshore trust and companies for clients all around the world, onshore as well as offshore. And if I've received a 100 Rand note for every time that a client has asked me, can my trust or my company invest back into South Africa, buying shares of my South African company, buying property, I would have been a wealthy retiree, playing tennis most mornings and drinking tea with my friends by now. So the answer up until the 31st of December has mostly been no to this question. But while we were all admiring empty beaches and taking small sips of our wine due to limited stock availability at the time, the Reserve Bank has issued a circular on the 4th of January announcing that loop structuring restrictions have been lifted, effective as of the 1st of January this year. So some of you might be very surprised by this. Some of you might have seen this coming. It was mentioned in our midterm budget last year. The fact is, it's official now. And with any change, there's lots of questions, uncertainties, and we couldn't think of anyone more pragmatic than Dr. Albertus Maree to clear up some of the questions that is on the minds of our clients and financial advisors. So it's with great pleasure that I now have the opportunity to introduce you to Dr. Albertus Maree. He is the founder of AJM Tax. He is a doctor of law. He's a chartered accountant. He's an advocate of the High Court of South Africa. He's a husband, and he's got 2 beautiful daughters. So yes, he has been very busy, hasn't wasted any time, and it's really impressive what you've achieved within less than 40 years, Albertus. So I'm going to hand over the floor to you, and I'm going to ask you your first question. Why now, after all these years, why do you think has the Reserve Bank lifted our loop structuring restrictions?
Corinne, thank you, and it's wonderful to have the opportunity to talk to you this morning, and specifically about what is a rather dynamic development, and we'll get to it later, but is, I don't think, the end of exciting exchange control developments that we can expect in the next month, really, so very short term. Look, what the loop structure regime entailed was that South Africans hold assets via an offshore structure or interests back into South Africa, or the common monetary area, really, comprising, of course, Namibia, South Africa, Lesotho, and Eswatini. So what it entailed was, for example, South African beneficiaries of an offshore trust holding assets in South Africa, or through an offshore company back into South Africa. And that wasn't permitted. Why it's being permitted now is that South Africa said, and Treasury specifically, has come about with a policy change to say that loop structure regimes were prohibited, or the loop structure regime existed at least to prohibit loop structures, which really brought about tax avoidance. So we used exchange control to combat instances of tax avoidance. And Treasury's new policy directive now is to say that exchange control should exist to protect the integrity of the South African rand as a currency, whilst tax avoidance structures should not be addressed through exchange control, but rather through tax avoidance mechanisms being brought about in tax legislation. I think that's quite exciting, is to say that let's not prohibit what could at times be very legitimate transactions being entered into, and really prohibit it under this a banner of tax avoidance. Let's have the Income Tax Act deal with those instances, and specifically the controlled foreign company regime contained therein, whilst allowing loop structures themselves. So that is the first point. The second is, and this goes to the broader relaxation of exchange control that we are expecting. You made mention of the Minister of Finance announcement in the budget of last year, and we saw that too in the interim and emergency budgets. is that we are expecting a whole-scale relaxation of exchange control in this country to be introduced imminently. Now, my contacts at the Financial Surveillance Department of the Reserve Bank tells me reliably that we can expect the introduction and the publication of details of the new capital flow management system to be introduced, and which will replace exchange control completely. Now, we've had exchange control in this country for 60 years. In fact, just Sunday past, on the 14th of February, we celebrated the 60th birthday of the South African Rand in this country. So it is high time that we look at a reconsideration of what it is that we're trying to do and why these things exist. So it's quite exciting that we are on the cusp really of moving into this new exciting regime where we will have an automatic yes system instead of the, at present, automatic no system. You know that you can't transact as a South African cross-border without exchange control approval in place from the Reserve Bank. That is going to change rapidly, and in the very near future, we're expecting those changes to say that all transactions are permissible, except for perhaps a predetermined number of transactions for which specific approval will be required. And this really goes to the broader relaxation of exchange controls and the realization of Treasury that the South African tax base has shrunk significantly over the past number of years. Treasury has quite clearly realized that we live in an overtaxed society and that the increase of tax rates going forward will in fact lead to a decrease in tax revenues. And it's for that reason that, plainly speaking, we need to open up South Africa's borders even more to the rest of the world to ensure that we attract wealth from other nations to this country, to tax it here and to grow the tax base, and also to allow South Africans to invest into the world and therefore return profits at some stage, which we can tax in this country then. So it's to say that we need to attract wealth from other countries to be able to grow the tax base. We cannot rely on the tax base in its existing form to continue growing against tax rates that we are presently confronted with.
Okay, so I mean that's all very positive, and I'm sure South Africans have been welcoming this news. What about the clients that are concerned about structures that they had where before the 31st of December were in breach of loop structuring rules? Are they supposed to do anything? Can they leave it as is? What would you suggest? What course of actions should they take?
Sure. So I mean, what we saw is on the 4th of January, this circular 1 of 2021 by the Reserve Bank was published, saying that we will now allow loop structures. And the reason, of course, why loop structures became permissible is because we've had anti-avoidance legislation introduced through the parliamentary process last year, and that we watched quite keenly, and that got enacted and became effective 1 January 2021. So what Treasury did is to say that we now have sufficient protection of the tax base through tax legislation to allow loop structures to exist. But in the same breath then, we didn't have protection for loop structures that existed previously. And for that reason, the announcement only permits new structures to come into existence. Previously existent structures still contravened and is still currently in contravention of prevailing exchange control policy of the Reserve Bank, and therefore, plainly speaking, amounts to an illegal structure. It is one that requires to be regularized. So it is not something you can simply sit on. It is one that would need to be disclosed. Considering, though, where we are at the moment with exchange control policy, and that in the past penalties could have been levied against these structures if discovered, I myself am strongly encouraging my clients to go forward to the Reserve Bank to say that we have a loop structure in place in one or two of our structures, and we want to regularize it. Can it remain in existence? My view is that the Reserve Bank will countenance those structures. They will be allowed, and provided that the structures weren't used to affect tax avoidance in any way. In other words, there wasn't any prejudice to on the fiscal front for South Africa, that there won't be any fallout as a result. And it's simply then a matter of coming forward and saying, listen, we've had this on the books in the past. There's been no prejudice whatsoever. You have tax legislation in place now to ensure that there won't be any prejudice to South Africa going forward. Here is what it is at the moment. And Corinne, on the same breath, I want to just mention that whilst loop structures are now permitted, one still needs to notify the Reserve Bank of those structures coming to existence. Yes. So it's not a case of simply entering into these transactions and creating these structures and off you go. You still need to write a letter to the Reserve Bank to notify them of the fact that you have perhaps a structure like this in place.
So how would you go about that? So I'm a beneficiary of an offshore trust. I know that this trust has made a loan to me. I never informed my bank. Funds came in. Well, I guess you would have had to. The bank would only have released the funds with a reference number. Maybe you bought shares of a South African company. That might be a better example. Shares have been issued by your company secretary on this side. Maybe the share certificate hasn't been endorsed non-resident, but you want to now regularize your affairs. How would do I go to my bank? How do I communicate with the Reserve Bank directly? What is that process that you would follow? Yeah. And can you yourself do it? Would you have to go see someone like yourself or tax practitioner? Can you just give us some indication as to how and what would be the right way to go about it?
Look, it's actually, I mean, exchange control is often seen as this murky specialist environment and no one really understands how to go about it. It's actually quite simple. So the Reserve Bank has a number of so-called authorized dealers, institutions that it authorizes to act on its behalf and to deal in certain transactions. Because the Reserve Bank simply doesn't have capacity to deal with all of the run-of-the-mill type of transactions. So it authorizes the commercial banks, I mean, all the ones that you and I will know, Investec and ABSA and FirstRand and Standard Bank and Nedbank and all of them, to engage in certain transactions or to authorize rather certain transactions on its behalf. So there's a mandate issue. So what you do is you write a letter to your bank telling them of the details of the structure and asking them to please place it on record with the Financial Surveillance Department. It's as simple as that. In order to ensure that you arrive at the correct individual, perhaps, with the Exchange Control Department of the relevant bank, it may be useful perhaps to make contact with someone such as ourselves that deal with exchange control from time to time. And I think also perhaps to be sure that as a result of the structure being regularized, there aren't any other skeletons crawling out of the closet that perhaps need to be addressed first and that need to be taken into consideration. But other than for that, the process is extremely simple and I would say quite cheap to, frankly, to engage in.
Okay, and then turnaround times. I guess there's quite an influx now of applications to invest back into South Africa. Do you have any idea what a person can expect? I submit a letter today to FNB. How long before I will hear back from them?
Yeah, so I mean, if it is to regularize a historic structure, that in all likelihood will be advanced or escalated to the Reserve Bank itself. So you're looking at 2 weeks approximately for the local banks to process the application and then to make a recommendation to the Reserve Bank, and they take approximately 3 weeks to come back. If it is that you're going to create a new structure today, we've had our example of South Africans setting up an offshore trust and that trust investing back into South Africa. If that is the case, then really you simply need to write a letter to the Reserve Bank through the authorized dealers, informing them that that structure is coming into existence. So then no prior approval or anything is necessary. You can happily go along with your structure and implement without having to wait for a response from the Reserve Bank. In fact, the notification itself doesn't even warrant a response from the Reserve Bank. So I don't think one should even wait or expect to hear anything back. It's simply to place on record what is taking place.
Yeah, that's quite interesting. It's a massive relaxation. I've also read in the circular, they refer to at arm's length transactions, valuations, independent auditor. If you have a South African company, your offshore trust is buying shares in this company, the company would have an auditor. Would it be that auditor that would prepare the valuation, or does it really need to be a third-party auditor that has got nothing to do with the South African company that prepares the audit or the valuation?
Yeah, so it can be any auditor. There's no requirement. What the Reserve Bank wants to see. And look, again, it's taking over some part of really what is a tax roll from SARS. It's all got to do with transfer pricing, to ensure that we are not transferring assets that will generate income in future, that would have generated income for the South African fiscus, now generating income for another country. So it's to ensure that when we transfer those assets out, that we transfer it out at market value. And the same for services and fees and sale of goods, etc. The Reserve Bank wants to see that the transactions take place at arm's length. Now, it is already a requirement in terms of tax laws for that to take place. So our Section 31 of the Income Tax Act says connected persons transacting with one another need to enter into arm's length transactions. Otherwise, SARS can make an adjustment to that price for tax purposes. It's for exactly the same reason that the Reserve Bank says, I want to have some sort of proof. I want to have some sort of assurance that what you are doing is in fact not eroding the tax base in this country, so to speak. So therefore, I need an auditor's certificate to confirm that the market value that you claim the transactions taking place at is in fact market value, as has been negotiated between parties that would have been at arm's length with one another in an open market environment. So it can be any auditor. In fact, I would argue that one's own auditor can do it, because simply that auditor too needs to be independent, at least, to be able to audit financial statements. So there's no requirement on who it needs to be. I've in the past had quite effectively, I think, the approach with my clients that the company itself conducts a valuation and puts forward an argument why a transaction takes place at market value. And then you ask the auditors simply to review that process and the valuation methodology, and to write a one-page report, really, to say that they've considered the valuation methodology, the circumstances in which the transaction takes place. They think it's in order, and therefore the valuation proposed by the board of directors appears to be one that is representative of arm's length consideration. So it sounds complex. It's rather your auditor saying it's market value.
Okay, that doesn't sound too complicated. The other question, this is a client question that came through yesterday. Does money actually have to flow? Now the trust or the company is buying the shares here in South Africa, it might not have sufficient funds to pay the market-related price, but when it receives its first dividend in 2 or 3 years' time, it will obviously be able to pay for the shares. However, can we do the transaction and postpone the payment terms until that point where the structure actually has received dividends or other income to be able to pay for the investment in South Africa?
Sure. So it depends on what type of transaction is involved. For example, if you're going to sell intellectual property from this country to another entity, again, something that was prohibited until very recently, and it's also been relaxed 2-3 years ago. Yeah. In terms of the regulations, or the manual at least, dealing with the sale of intellectual property, there is a requirement for the sales proceeds to be introduced to South Africa in cash within 30 days of the transaction being concluded. So in that instance, you need cash. In all other instances, though, and it's one of the reasons why why I don't like dealing with exchange control matters, and do so reluctantly. However, you cannot run an international tax practice nowadays without having detailed knowledge of these things, is that it is subject to the whims of the Reserve Bank. I mean, it's in the end, it's policy. And in fact, the Currencies and Exchanges Act uses those exact words to say that the Minister of Finance really can delegate his authority to the Governor of the Reserve Bank, which of course has taken place, and he can make regulations on what would be permissible or not. So really, these things are in and out, and there's no hard and fast on what is permissible or not. In my experience, we've had an inconsistent application on most transactions, and it appears as though the Reserve Bank is willing for debt-related transactions on loan accounts to be entered into, if there is sufficient justification why we cannot have cash flow on those transactions, and provided, of course, that the loan terms have appropriately been agreed to. Now, appropriate loan terms would typically be an interest rate linked to prime, for example, depending on whether South Africa will be the interest recipient or payer. it may be that the Reserve Bank would want to see those rates increased or decreased depending on what the type of transaction is. The Reserve Bank will be very happy to say that if South Africa or South African resident is going to be a borrower, if the interest rate is going to be prime less 4 basis points, for example, the Reserve Bank will be very happy. If it is going to be the other way around and you are going to be the lender as a South African resident, prime plus 4, for example, will be something the Reserve Bank will be very happy to accept too, of course, because it grows the tax base and at the detriment of another country. So South Africa is always going to be happy to accept those types of terms. What I'm trying to say is that, yes, depending on the loan terms, it is quite possible for the Reserve Bank to allow certain transactions on a cashless basis. There is definitely a strong preference for cash flow, but it is not an absolute requirement in most transactions, at least.
Okay, on that point, it's another client question that came through yesterday. When you have an offshore trust and the trust makes a loan to you in South Africa, that loan, can it be interest-free or does it have to be interest-bearing? I'm just thinking there's possibly withholding tax on interest payable, so SARS would lose out on that withholding tax if it was interest-free. But we know if you loan from SA interest-free offshore, it's a deemed donation. But what happens if it's the other way around and the loan is interest-free?
So South Africa would always want so-called market-related terms being agreed to. And there is a potential tax whether South Africa is the payor or the recipient. So as I mentioned previously, in terms of our Section 31 in the Income Tax Act, connected person transactions must always be at arm's length. And the reason for that is if South Africa receives interest, we will pay income tax on it. If South Africa is going to pay interest, interest withholding tax will apply, especially in instances where we're dealing with a country where we don't have a double tax agreement in place. So, for example, South Africa has a double tax agreement in place with the United Kingdom, in terms whereof the two countries, I mean, Her Majesty's Revenue and Customs and SARS on this side, have negotiated an agreement on behalf of the two governments to say that it is not in the interest of either country for double taxation to take place. I mean, otherwise, no one's ever going to do any transactions between South Africa and the UK. I mean, tax rates in this country is already extremely high, and the UK isn't exactly a tax haven. I see coincidentally that it's been proposed for the corporate tax rate to be increased this year in the budget, to be tabled in the next month. So we therefore enter into this double tax agreement to ensure that if South Africa withholds a withholding tax on interest paid out, that we shouldn't also be claiming or levying an income tax on the UK side. That would be a double tax on interest. In terms of the SA-UK double tax agreement then, for example, Article 11 determines that South Africa will not withhold any interest, withholding tax, if interest is paid to an entity in the UK. So South Africa would be very happy if we make a loan, or sorry, if we make interest payments, we borrow from a UK-related trust or company for that loan to be interest-free. Because in not paying interest, we're not claiming any deductions. We wouldn't have been allowed to withhold withholding tax in any event. So there's no prejudice to South Africa. In fact, South Africa benefits. The UK side, however, is somewhat different. HMRC will very definitely want to see interest being levied and at market-related interest rates that they can tax it on. So it depends on the environment, but yes, the rule of thumb is always market-related interest, and it can't simply be interest-free. An interest scenario that I've come across nowadays, though, with interest rates and international markets really being so extremely depressed, is that a market-related interest rate, especially on pound or euro-denominated loans, could very well have the effect of being 0% or very close to 0%. I mean, we deal often, we hear of this strange notion in Europe, which we don't have in this country, of course, of negative interest rates. Yeah. So I mean, in that fiscal environment, I think there are definitely circumstances where you can say we are going to lend or borrow at the base lending rate on a loan that is euro or pound denominated, and therefore practically a zero interest rate is going to be something that one could defend if challenged by either revenue in this country or abroad.
Okay, so thank you. That is very interesting. We often get that question where clients want to make loans out of SA to the other side or into South Africa, and whether they can denominate that loan in a different currency to benefit from the lower interest rates that can be charged. So thank you for clarifying that. Same client, same trust, has loaned money to South Africa. Trust owns an apartment in Sea Point. 5 years down the line, sells it, nice gain. At what rate would he pay a capital gains tax, seeing that this trust is not really a taxpayer in South Africa? How would that calculation work?
Corinne, you used the word taxpayer, and I want to come back to tax residence perhaps in a second as a separate concept to talk that through. But the foreign trust is of course not a taxpayer in South Africa. It is a taxpayer in this country. It is not a tax resident. A taxpayer is someone that pays tax in this country. It's either one that has, if it's not a tax resident, that earns South African sourced income or South African sourced gains, or it is a South African tax resident who pays tax based on his or her or its worldwide income. So in your case, the trust, yes, is an offshore trust. It's run offshore, but it is still a South African taxpayer if it earns South African sourced income. Let's say the South African property is being rented out. That income will be subject to tax in this country. And that is irrespective of whether South Africa has concluded a double tax agreement with another country or not. The fact is that the source of the income is in South Africa, so South Africa will, in terms of its domestic rules, seek to tax rental income. The same applies to capital gains on the sale thereof. Irrespective of whether the trust is situated in a country or jurisdiction with which we have concluded a double tax agreement or not, that rule still applies. The reason for that is that all of our double tax agreements contain a clause to say that the taxation of gains or income from immovable property in South Africa will be taxed in South Africa. So if those gains are made and realized by the non-resident trust in your instance from the flat in Sea Point, it will be subject to tax in South Africa at the rates that would have applied ordinarily. Now you'll know that the tax rates for trusts is extremely high. It's close to being penal almost. It is 80% effectively of your profit is included in taxable income, and taxable income is taxed at 45%. So therefore, the effective capital gains tax rate for that non-resident trust in South Africa will be 36%. That is, of course, unless the trust distributes an amount of that gain to any beneficiary in South Africa, in which case the income will be taxed in the hands of the beneficiary at his, her, or its income tax rates, and which is likely to be significantly less. So, for example, if we distribute the income to my South African beneficiary of that offshore trust, which I would recommend be considered strongly, then the capital gains tax rate would at maximum be 18% and no longer the 36% flat rate that would have applied in the case of the offshore trust.
Okay, thank you very much for that. So in a case like that, where you decide, well, you're going to take benefit of rather paying the capital gains tax at the beneficiary rate, would funds have to flow? Now you've sold, trust have sold the property. Can you keep the money here in rands, or would we have to see money leaving the country, get converted, come back, get converted again?
So you don't need actual cash to flow. It is likely as much as an accounting entry to say that we're making a distribution to the individual. But what that does, though, is it creates a loan, obviously. So to the extent that I have a gain, a profit that I want to distribute to my beneficiaries, a loan is created if I'm not going to actually pay out the cash, meaning that that individual has a debit balance, a receivable amount in favor of it from the trust. And now again, we sit with the interest question. Now I have a loan from an offshore trust as a South African on which I need to consider whether arm's length interest rates are charged or not. Of course, the other potential fallout from the distribution is that you have an increased estate. if I'm going to distribute my profits to the individual, now suddenly I have the profits in my own estate. And if I pass away very soon thereafter, be it from COVID or not, hopefully not, then I have a bigger estate duty problem. So the question really, I think, or the matter to be considered by clients would be whether it is appropriate for those funds to be transferred or distributed to a South African beneficiary individual, or whether perhaps it is more appropriate for it to be distributed to the domestic South African structure. Look, a number of clients always look to offshore structures, which of course is extremely pertinent and appropriate. However, a South African structure has certain marked benefits too. So my advice typically is to have a parallel structure. South African trust with companies, as well as your offshore trust with companies. So if we're going to distribute these profits, for example, to a South African company held by a South African trust, yes, the capital gains are now taxed at slightly higher rates of 22.4%, as opposed to the maximum rate of 18% that would have otherwise applied. However, at least now I have protection from estate duty and not increasing the taxable estates of the individuals that would otherwise have been taxed at 25% when that person passes away, together with potential capital gains that need to be paid, in realizing assets that you need to sell to pay the estate duty. It quite quickly becomes a race to the bottom if you have an estate duty problem, which is why I prefer to pay the slightly higher capital gain yet retain the profits in a domestic trust structure on this side.
Yeah, wow, it's fascinating. You really can't just look at it per transaction. You need to know what your overall plan is, and I guess what type of legacy you want to leave, and do you want to leave it in SA or do you want to leave it in hard currency on the other side? Albertus, this is where it gets really fun. When I do what I do, when we need to decide where do we put holding structures, where do we put the offshore trust. We've heard last year favorite nation clauses was suddenly talked about, and there was a couple of presentations that I've attended on that. Netherlands seems to be quite favored among the South Africans. Maybe it's we like the Kaapskopper and we can probably understand them the best of all the European countries. So where do we put our holding structures if we want to invest back into South Africa?
Yeah. The question becomes, of course, much more pertinent now, seeing that South Africans can invest back into this country via an offshore structure. Look, on the question of most favored nations clause, and we'll get to that, or the structure itself, perhaps in a second. Or perhaps let's deal with the structure first. What you want to do when you invest offshore or back into South Africa via offshore is you need to be sure why you want to do it. Is it for estate duty protection? Is it for exchange control benefit to have money outside of exchange controls? Is it that you're concerned of currency risk? Is it that you're concerned of political risk? What is it that you want to achieve from that structure? I think clients need to be very clear on that. But once they've made that decision, then the question becomes on where. And quite typically, one of the justifications for investing offshore is tax related. Is to say that I want to see whether I can generate income in a lower tax jurisdiction. So what you look to then is firstly a jurisdiction with low tax rates. That makes sense. And that's why historically Mauritius was so extremely popular. I say historically because you'll know that the world has clamped down on Mauritius somewhat, I think unjustifiably so. Poor Mauritius is being made out as the bastard child of the tax community, whereas no one is saying anything about Isle of Man or Jersey or Guernsey. But I mean, that is perhaps a discussion for another time. Mauritius still has a very lucrative regime in place if managed appropriately and managed by a responsible advisor. So I do think that it is still something that is relevant. I wouldn't go to Mauritius on my own. I would be sure that I have people who can attend to my affairs there. So that is important. The second, with low tax rates, would be a country with an appropriate tax treaty with South Africa. Now, we've said earlier that double tax agreements exist to ensure that we don't have tax being levied in both countries on the same income stream, effectively. meaning that if I am going to invest back into South Africa through a loop structure, I have an offshore structure as a South African beneficiary, and that structure invests into this country, be it in the form of immovable property held in Mooly Point, a loan advance to South Africans, shares in South African companies. I mean, those are all examples of loop structures. It will be important for the income generated by the offshore entity from the South African assets to not be taxed in both SA and abroad. For example, if I have a share investment from my Guernsey company or trust back into South Africa, and there will be a dividend declaration from South Africa to the offshore company, there would be a dividends withholding tax in South Africa of 20%, because South Africa doesn't have a withholding tax agreement in place with those jurisdictions. It does, however, have such an agreement in place with the Netherlands, the UK, Mauritius, all of the major trading partners, really. In fact, South Africa has 77 double tax agreements in place. By far the most significant treaty network of any other country in Africa. So I would look to a country with an appropriate tax treaty too. I would look for a jurisdiction where I am able to trust advisors to look after the structure. And why that is important is I can't have a structure offshore for tax reasons if that is all I do, is I've set it up offshore, but I do everything from South Africa. Tax residence is globally not determined by virtue of where a structure is set up. It is where that structure is managed from effectively. And that is why either it needs to be a jurisdiction where people can travel to quite easily and have board or trustee meetings there to manage the affairs of the entity from time to time. Passive entities, of course, are much easier. They don't need to be managed that often. Again, why Mauritius was so popular. It was easy for South Africans to travel to. Unless, of course, you're able to pay an advisor to look after the affairs of the company or the trust on your behalf, such as sovereign, for example. You'll be familiar with that. So those are the type of things that we look at. Ease of management, to ensure that it's easy to manage it from there. Cost in doing so. Political risk of that jurisdiction, whether it's safe, stable. The tax environment, both domestically, high tax rates or not. And then the withholding tax rates applicable to that country. The withholding tax will ultimately be a function of double tax agreements negotiated between that country or jurisdiction and South Africa. The most favored nations clause that you've referred to earlier is a fascinating factual example. I'll talk you through the facts briefly. It was, I think, if memory serves, ITC 1859 tax court case. It was published in June of 2019, delivered by Judge Hack. Now, perhaps some interesting trivia. Judge Hack used to be an engineer in his previous life before deciding to go and study law, and then ended up at the bar, and then, of course, elevated to the bench some years later. So it's quite interesting reading the judgment. It is quite methodical and well-reasoned. I thought a remarkable piece of analysis. What happened with the most favored nations clause? What it is that in terms of treaties entered into between countries from time to time, sometimes with some of your most significant trading partners, there will be a clause inserted in, especially the dividends withholding tax clause in the treaty, that says that we agree to a 5% withholding rate, for example, only between South Africa and the Netherlands, the treaty in question in that case. However, if you enter into a better treaty, a better agreement with another country to reduce the rate to 0%, for example, then we want access to it. You can't give more favored treatment to another nation than to ourselves, because we are one of your most significant trading partners and we want the best treatment. Okay, so South Africa enters into a new double tax agreement with the Netherlands. It enters into a so-called protocol, amending the previous agreement. To say that we have a withholding tax of 5% on dividends paid from South Africa to the Netherlands. However, Article 10.10 of that agreement says that should South Africa enter into a better agreement, more reduced rates effectively, with another country after that date, we want access to the same rates. Then the rate in this treaty will be similarly reduced from 5%. After that, South Africa enters into an agreement with Sweden in terms whereof it introduces also a most favored nations clause in that treaty, yet also reducing dividends tax to 5%. In terms of that agreement, Sweden says, if you ever enter into an agreement after this date, if you've ever entered into an agreement with another country, not since this date, ever, that is better, we want better rates. Everyone forgets about the double tax agreement with Kuwait. Kuwait, of course, is very important for South Africa as a strategic partner, because it is where the majority of our oil is being imported from. So that is the reason why historically Kuwait has had a 0% withholding tax on dividends. So by virtue of entering into the Swedish protocol, the Swedes say we have now 0% because Kuwait gets 0%, and the Netherlands say you've just entered into an agreement with Sweden in terms whereof they have received 0%, so we want 0% too. So that case goes to court. We don't know who the taxpayer is, but it is rumored that it is a taxpayer with a significant interest in a tech firm in China, and that has recently double listed in the Netherlands. So you can imagine the tax revenues, sadly, that South Africa has lost is apparently billion. It is massive. The bigger problem is that, you need to feel sorry for government as a result too. It is something that has been overseen by advisors, government, in negotiating these things for a number of years. It's quite clearly been an inadvertent oversight. But the only way in which to rectify it is through renegotiation of the Kuwait Treaty, is to tell the Kuwaitis that we need to increase that rate to 5%. And apparently they're digging in their heels and saying no, they're not willing to. And there's a political stronghold that they have over this country because of the significant oil reserves that they have and that we rely on in terms of our importation contracts. So it leaves us from a South African perspective in a very difficult space. What it does do, though, is it creates a planning opportunity for quite a number of clients to say that I can structure my affairs through the Netherlands or through Sweden without paying any withholding tax on dividends from South Africa abroad. So if I have, as a South African, a Dutch structure investing back into this country, dividends paid from South Africa to the Netherlands will be at 0% withholding tax in this country. And due to a significant interest being held by the Dutch company back into the South African entity, it is likely that the foreign dividends received by the Netherlands entity will similarly be tax-free there. So, yeah, that effectively is one of the big pluses for using the Netherlands or Sweden, or if you're feeling adventurous, Kuwait, as a jurisdiction in which to set up an offshore structure. The important thing, though, is to remember that dividends withholding taxes aren't the only thing to consider. It may be the most significant one. So for certain clients with a certain fact pattern, it makes sense. You need to also consider the corporate tax rate in the Netherlands is quite high, and which will, of course, be quite relevant if ever the shares in the South African company is going to be sold. You will have a significant capital gain there in the Netherlands. Yes. So these are all things that one need to take into account. But as far as dividends are concerned, yes, you won't get a better treatment for an offshore structure as you have in the Netherlands, Sweden and Kuwait. If you're willing to settle for 5% withholding tax rate, then of course our other treaty partners in the lesser tax jurisdictions remain entirely appropriate, be it Malta, Luxembourg, Mauritius, and the rest of the other jurisdictions that you will be well familiar with.
Okay, 100%. Yeah, we've done a couple of structures where Singapore was set up to be the holding company. In the past, we've looked at Hong Kong. Hong Kong has got a couple of issues at the moment, so I think people have started to become a bit nervous. But yeah, that's really the fun part of our job, where we start to really give some color to the offshore structure by choosing the jurisdiction. I think seeing that we're on the structuring itself, do you foresee any significant changes in our CFC control foreign company legislation to come out in the budget on the 24th of February?
Not immediately. So what is interesting is that I think we've seen a number of legislative tinkerings, if you will, with the trust regime, both as it relates to the domestic trust as well as to offshore trusts. So I don't foresee any real changes. There is quite clearly, or the CFC regime is quite clearly, government's preferred method of addressing the taxation of loop structures going forward. So what the tax legislation is, and that's why it wasn't a real surprise, the announcement on the 4th of January of this year. We've seen draft amendments being introduced since last year already, in terms of where government said that we are going to introduce tax measures to ensure that where South Africans hold more than 50% of the shares in an offshore structure that holds South African interests, we will tax South African dividends received by that offshore company. We will tax capital gains on sale of shares and other assets made by the foreign company, etc. So I mean, those were the changes introduced. My reading of the Act at the moment appears that these changes are quite effective. There is a big question mark against where the loop structure exists, not through CFCs. In other words, South African companies held by offshore structures, and the offshore structure is held by South African, where offshore trusts rather are utilized. South Africans, of course, can't own a trust. You can't own an interest in a trust. You are simply a beneficiary of that trust. So still excluded from the CFC regime would be loop structures where South Africans hold interests in South African companies via an offshore trust. So there the CFC regime doesn't cater for tax avoidance. So it may be that at some stage we will see measures introduced to address that structure. Presently, we already have tax consequences where the offshore trust eventually distributes offshore gains and dividends to this country. So it may be that South Africa is happy to play the longer game, to say that we're happy not to tax it for the moment. We will tax it whenever you bring those distributions or the profits back to South Africa. That may be the case. I think, though, that we have a short-term fiscal problem and that we need to address, perhaps need to engage in more urgent legislative need, or legislative reform rather. So I don't see how they can tax it effectively, but it is something, given the relaxation of loops, that will need to be addressed, I think, at some stage. Whether we're going to see it as part of this legislative cycle, I'm not entirely sure. My own guesstimate is not. I think that government has some way to go still on formulating policy and how to more effectively tax offshore structures that invest back into South African assets.
Well, thank you. I'm just conscious of the time. We've got another 10 minutes left. Benry has brought in some questions that have come through on the portal. So I just want to see if there's any questions that we haven't touched on that I can ask you. And then I've got one final question, which I know we've spoken a lot about. I think you might know what's coming. And let's just have a look here. Are there limits for the interest rates charged or paid? That's from Charles Winshaw. I assume that's on loans. So we have to touch on that, market related, especially if they're connected parties. But maybe if they're not connected parties. So let's say you've got an offshore trust. The person taking the loan is not a beneficiary. It's not a settler of the trust. What would be the case then?
So if it's a genuine non-connected person, of course we have a connected person definition in Section 1 of the Income Tax Act. I won't bore you with the details of that rather conflated definition. But if it truly is an unconnected person, then there's no requirement for it to have a certain interest rate linked to it. It simply needs to be reflective of what is arm's length. Now, I mean, arm's length is what you would be able to get from any other potential borrower or lender, depending on your position in the market. Typically, therefore, it is bound to be the same rate as one would have with your commercial banks, and which will inevitably be prime rate, or prime linked at least. if it is a South African bank, or base rate linked then, if it is with an offshore bank.
Okay, so South Africa has decided to wake up and try to attract foreign investments by doing away with loop structures. Oh, this is just a comment. It took them long enough with lots of exclamation marks. But why will they now amend another section of the income tax, example section 9D, to make sure that they bring more into their coffers?
So what it is, why South Africa has woken up, as we said at the beginning, is to say that we needed exchange control to ensure that we don't lose out fiscally from a tax perspective. Let's use a very simple scenario of how loop structures affected tax avoidance in the past. I have a South African individual owning all of the shares in a Mauritian company. Let's use poor old Mauritius. And the Mauritian company owns all of the shares in a South African company. I would have been quite able to extract dividends from my South African company to the Mauritian entity for reinvestment wherever at a 5% dividend withholding tax due to the double tax agreement being in place. If I didn't have the Mauritian structure, I would have paid 20% dividends withholding tax. So South Africa loses out on that basis. The Mauritian company, of course, in turn, if it receives the dividend, can further declare the dividend out to myself, because Mauritius also doesn't have a dividends tax in place. So by virtue of using a low tax jurisdiction with a treaty with South Africa, I'm able to extract profits with 5% dividends tax, which I would have otherwise been able to do at a cost of 20%. So that's the first example. Second example involves the use of the so-called participation exemption. If a South African person sells shares in a non-resident company to a non-resident person, then if you had 10% of those shares at least, the capital gains is tax-free. So there is an exemption for capital gains tax in that instance. If I have a foreign purchaser wanting to buy my South African investment, I would have paid capital gains tax on the sale of it. However, if I now only sell the shares in my Mauritian holding company, which really is nothing in it other than the shares in my South African company, I would pay no capital gains tax on the sale of those shares. So it's for that reason why Section 9D was introduced, to say that, okay, we will allow loop structures because we can now tax it effectively. So now the loop structure prohibition is no longer needed. But barring the amendments to Section 9D and paragraph 64B, the participation exemption I've referred to, we needed the loop structure prohibition to ensure that we don't have tax leakage as an effect. However, as I said, the prohibition gave rise to unintended consequences in that legitimate transactions, where there was only a distinct or distant South African interest holding, had to go through rigorous checks and application processes previously before those transactions could be entered into. So it is those legitimate transactions which government says we want to see happening, and we will rather ensure that we don't have tax leakage through introducing what in the end happened to be rather simple amendments to the Income Tax Act. So it is really, yes, should have happened a long time ago, but we are there now. It should be encouraged. I'm quite happy for it.
Nothing happens fast in Africa. I've got a question here with regards to not taking South African money into an offshore structure. So you've got a company, it's managed or controlled offshore, it makes its money through trading. South Africa is not involved, but it is owned by a South African trust with South African beneficiaries. When those funds come in, my understanding was previously that would have still been classified as a loop structure and not have been allowed. It's now allowed. Does it make a difference whether the money has been made legitimately offshore or whether it's money from South Africa going offshore, coming back?
No. So if the offshore company is going to have any South African assets, including South African currency, rand, there will be a loop structure, and you need to inform the Reserve Bank. It's as simple as that. You can, of course, bring back money that you want to, and then it is subject again to South African exchange control. But if you want to keep it offshore and you want to invest it offshore in whatever assets, if it has been legitimately externalized, there is no requirement for it to be brought back to this country. You can use it as you please, provided it stays outside of the exchange control net. If it is brought back to South Africa, it will be subject to the exchange controls in that instance then again, yes.
All right, so my last question for the day relates to financial immigration. I know I've heard you talk about this a lot and in a lot of detail, but maybe if you can just very shortly comment on what's happening on the 1st of March. I want to leave South Africa now. I can't formally immigrate. What do I do with my pension? Now am I stuck with 10 million per year that I can take out? What is happening with regards to financial immigration?
Corinne, I can go on for a day on this topic, so you need to stop me when we're out of time.
We only have 2 minutes.
Everyone is extremely alarmed by the so-called expat tax in Section 1010's amendment and the residence definition in South Africa being amended as far as exchange controls are concerned. No one needs to be alerted. No one needs to be concerned. What we are doing is simply to align policy with the rest of the world. We want to, through the amendments of Section 1010, combat the incidence of double non-taxation, as coincidentally we have already seen the UK, the US, and Australia take steps towards. It's on the recommendation of the OECD. It is not the South African government desperately running around chasing its expats around the world for their money if they've left a number of years ago already. Financial immigration, or informing the Reserve Bank of your immigration differently, has no impact on one's tax residence status. If you are no longer ordinarily resident in South Africa subjectively is your home, your family and your pets and house and everything is offshore and it's been there for a number of years, you are no longer ordinarily resident in this country. Whether you told the Reserve Bank of it or not has no effect. Or if you spend less than 91 days a year in this country for 5 years after one another, consecutive years, then you cannot be a resident in this country. It is not a function of electing or informing or applying. Tax residence is a consequence of one's lifestyle. It is not something that you need to apply for. If it had only been that simple. It's for that reason why a number of, and I will call them that, unscrupulous advisors have said that it is as simple as filling in an MP 336B form with the Reserve Bank, and then all your tax problems will go away. It is not a silver bullet for solving tax problems. It doesn't affect it at all. In fact, in some instances, no, I'll say in most instances, my clients have already inadvertently, perhaps, immigrated a number of years ago when they left the country. They are no longer South African tax resident. I'm quite glad to see that we are doing away with this concept of financial immigration or exchange control residence come 1 March. It is in fact very closely linked to the relaxation of exchange control that we are seeing introduced come March of this year. The capital flow management system that we discussed earlier is to say that we are doing away with the concept of residence. Therefore, we now need to determine how and when will we pay out pension funds if people are no longer in the country. It used to be that if you told the Reserve Bank you're no longer going to hold accounts in this country, that you will then be able to cash up everything and take it out on pensions. You'll know, of course, that the case otherwise would have been that you weren't able to do that. You needed to apply to the Reserve Bank before doing so. Now we need a different determination of when you can access your funds. It's not to say we're going to block it. We just simply need another test. And that test is to say, if you can show me that you've been out of the country for 3 years on a tax residence basis, a substantive driven test, by the way, not a formalistic one, then we're happy for you to take your pension and go live somewhere else. But people tend to realize that they don't have enough, that pastures aren't as green as they thought it would be on the other side, and then return. And for that reason, this arbitrary 3-year period has been introduced to say that let's first see if things work out wherever before we allow you to access your pension funds. Corinne, a final note on this, and this is pure speculation. If the Reserve Bank is doing away with its concept of residence, I wonder whether it's not possible that in the budget that we will see a doing away with this whole 10 million threshold per year per individual on money being taken out. I've always told my clients there are 2 reasons and 2 reasons alone for immigrating for exchange control residence for individuals. It's to allow you to enter into loop structures, and it's to allow you to take more than 10 million rands abroad every year. With the loop structure regime gone, and the Reserve Bank being on record that it is abolishing the concept of residence come 1 March, is there still a basis for this 10 million rand allowance? And I think we may be in for some good further news. So let's see. But all the noise at this stage from the Reserve Bank is extremely positive and encouraging. I'm expecting massive changes in the next month.
So let's hope the Finance Minister will have some more positive news on the 24th of February. I'm sure you will have your very interesting and humoristic summary for us ready the day after that. So if there's any listeners, please feel free to get in touch with Albertus. He usually hosts this very lovely event. Now it will, I guess, be online like we're doing now in light of COVID. But I just want to thank everyone for attending today's session. Please feel free to get in touch with myself or Benry. If you need the contact details of Albertus and his team to maybe have a consultation within the next couple of days or during the course of the year, let me know. We are more than happy to share his contact details. Yeah, I hope everyone stays safe and speak to you soon. Thank you very much.
Thank you, Corinne.